Hey guys, it's Denise Donoghue, your mortgage banker, and it is so important to have at least a basic understanding of how mortgage interest rates work and why they go up and down and what makes up an interest rate. So I wanted to take the next 5 minutes and walk through this packet with you because I don't expect you to be a mortgage wizard like myself, but this is probably the largest purchase that you'll make in your lifetime. So you really want to understand how the mortgage interest rates work. So the first thing that I want to do is give you a little bit of a history behind the interest rates. So basically, prior to 2009, there were only two types of loan programs. You had the conforming and you had subprime, which is also known as non-conforming. And basically, if you qualified for conforming, it meant that we could verify your assets and your income, and essentially everybody who fell in this bucket got the exact same interest rate. And if you were in this bucket, it was more of the stated income type loans, things that made kind of common sense, but we didn't have documentation to prove it. And a lender could charge you an arm and a leg. They could charge you anything they wanted. There wasn't any kind of regulation around this. And so, of course, around this time period is when our economy took a big hit and the crash came about. And so Dodd-Frank and the CFPB came around at this point and said, okay, no more. A lender cannot charge just an arm and a leg to get a mortgage deal done. And so now every single bank, every single lender follow a system that's called the Loan Level Pricing Adjustments, or the LLPA. And there are 30 different types of adjustments that a lender looks at to determine what interest rate they're going to give you. We call this your individual mortgage scorecard, or I like to call it what is the DNA of your specific interest rate. And you'll see here in this chart the 30 different adjustments that actually go into your interest rate. It's going to be things like your loan amount, the length of time that you have the loan for, credit score, your assets, things like the co-borrower, credit history. There's some things on here, of course, citizenship, the underwriting system that we use, whether or not we're looking at 2 years or 1 year, and all of these things, some are within your control and some are not. Some are just pertaining to the actual property and the underwriting process. But we have to know these 30 things to get a complete individual mortgage scorecard. So when I tell you that, a lot of times when we see advertisements, or I even say if you were the owner of ABC Bank and a client called one of your employees and said, hey, what are the going interest rates today? How are they going to answer that question? Well, all the marketing and what most mortgage bankers do, are they going to assume best case scenario for your mortgage scorecard and then quote you a rate that may or may not be accurate. So the only true way to get what your interest rate is going to be is to look at this loan level pricing adjustment, which is your individual scorecard. So next, what's very important is to explain to you how we work at Service First Mortgage. We actually have the ability to shop over 32 banks. This is absolutely the number one reason why you want to hire my team, is because we don't just represent one bank. For example, if you go into Wells Fargo, the Wells Fargo loan officer is only going to be able to look at the Wells Fargo interest rates. Well, we can look at all of these companies because we shop over 32 banks. So what we do is we help you find the lowest interest rate. And basically how this process works is there's a pool of investors that put their money together and they lend the money to Fannie Mae, Freddie Mac, Ginnie Mae, and Fannie Mae pays them a rate of return on this money. And then what Fannie Mae and Freddie Mac do is they take this same money and they lend it out to the big banks, who then take the money and lend it to you. And so at each part of this process, of course, there's a rate of return or an interest rate. So if Fannie Mae and Freddie Mac are lending to the investors at, let's just say 3.75, well, they're not going to lend to the banks at that same rate because they won't make any money. So they're going to add a little bit of a rate adjustment, and let's say they lend to the banks at 4% interest rate. So now the banks are borrowing money from Fannie Mae at 4%, and we know they're not going to lend you the money at the same rate that they're paying for it. So they're going to add their little percentage to it, and that's what's called the servicing fee. So, and it's public information. We get a report every Thursday that shows what they're lending to the banks at. So I can see what the servicing fee is. This servicing fee that they give to you is based on that loan level pricing adjustment. That's how they determine how much risk and essentially how much money that they want to make off of you. So what's really important is now that we know, okay, yes, we're going to shop to find the bank that's going to give you the lowest servicing fee. That's only half the equation. The other thing that we have to know is, should we float or lock the rate? And the only way to know that is if you're hiring a mortgage banker that actually studies the bond market, just like a stockbroker studies the stock market. Because the only reason why interest rates go up and down throughout the day or throughout the year is solely in part of those mortgage-backed securities or the bonds. So if the bond prices are high, interest rates are low, and vice versa. If the bond prices are down, then interest rates go up. So we have to be paying attention to the bond market, and that's the only way we can advise whether or not you should float or lock the interest rate. To give you an example, in this 60-day time period back in 2013, the interest rates actually went up a full 1.5. That means if you were pre-qualified prior to May 1st of 2013 and you didn't find your home until after July 1st, well, your interest rate is a bit of a shock because that's how much they moved up in just 60 days. So you need to be able to monitor the market, and the mortgage banker is going to say, hey, Mr. Customer, interest rates are going up. You need to lock in as soon as possible. This is an example of what the rate market did just in a 30-day time period. In September of 2014, the interest rates actually went down a full percentage point. And then here gives you an example of how they moved in just one single day. In October of 2014, the interest rates actually moved down 0.5 point and then back up 0.5 point. So if your mortgage banker isn't studying the bond market and the economic events to know what rates are going to do, then how do you know to float or lock the rate? Just like when you buy a stock, you want to buy the stock at the lowest price possible. So it's really important to ask yourself, do you want the lowest interest rate today or by the time you close? And again, you have to hire a banker that pays attention to the bond market. This is an example of the things that I pay a lot of money for to monitor the bond market. This report here comes out every Sunday, and it tells me all the economic events that are going on throughout the week so that I can gauge whether or not it makes sense to lock or float. There's also a market commentary by Larry Baer who gives us his opinion on whether or not we should float or lock. This is the Freddie Mac report. Remember previously we were talking about how every Thursday it's public information what Freddie Mac is lending at. Well, we can see what these rates are. Again, every Thursday I get this report, so I can email this to you. It comes from our chief economist, so we can see what the banks are paying, and then we can get an idea of course, what your interest rate is going to be. These two charts show you how I monitor the rates every single day. I get text alerts, and it allows me to be able to forecast and, of course, watch the trends. So I am in tuned every single day with how the bond market is performing. So the next question I want to ask you is, how familiar are you with the term points? Points are what are used in all the marketing and advertising. It's basically how a person or a consumer can buy the interest rate down. It's also how all the advertisements are posted, what you see on inside banks and on TV commercials. You can get an interest rate as low as 3%, but you're going to pay 1,000,000 points to get it, so to speak. So you really have to look at what each rate is costing you, and a lot of times mortgage bankers don't break this down. And what I really like about this chart shows you on a $250,000 purchase price, well, how much does a quarter of an interest rate cause your payments to go up or down? And this is really what this illustration is for. You'll see that at a 4.25% interest rate, it costs you $0 for this rate. That means there's no points that it costs for this 4.25% interest rate. Of course, if you wanted a little bit higher interest rate at 4.375, you'll see that this is in red. What this means is that the bank would actually give you a credit towards your closing cost of $1,250 for this interest rate. This is how some banks advertise a no-cost loan, or how there's builder incentives. It's just because they're giving you an incentive, which means it's a higher interest rate. That's how they're doing it. You just don't normally see this kind of chart. But to answer the question, what does a quarter of a point difference in rate do? Well, a 4.25 versus a 4% interest rate. The cost of this 4% interest rate is $2,188. As we know, the cost of 4.25 is zero. But what does that do to your monthly principal and interest payment? Well, the principal and interest payment on 4.25 is almost $1,230. On the 4%, it's $1,191. That's a difference of $38 a month. So does it make sense to bring $2,188 to closing to get this interest rate? We all want the lowest interest rate, but does it make sense to do? The only way to answer that is to look at your break even. The break even is 115 months. That means that you would have to save $38 a month over 115 months to even recoup this $2,100 you paid at the closing table. That's crazy. That's almost, what is that? That's almost 10 years that you would have to stay in that home and keep that mortgage to actually make it make sense to get the 4% interest rate. Of course, lenders and most mortgage bankers, I mean, if you go into a big bank today, you could ask them, hey, why do interest rates go up and down? And what is the loan level pricing adjustment? They probably don't even know what that is and what that means because they're only looking at their bank's interest rates. And they definitely won't do this. They won't break it down for you. They'll just say, hey, the average consumer wants the lowest and best interest rate, so we're going to show them this 4%. But that doesn't even financially make sense to do. And so you really need someone that's going to advise you properly so that you can get the best interest rate and really the total overall cost for your home loan. So I just wanted to say thank you. Again, I don't expect you to be mortgage wizards, but hopefully that's helpful to know a little bit of the background behind the interest rate market so that you feel comfortable throughout this process and that you know that it's super important to hire a mortgage banker like myself that monitors the bond market and can give you the best advice, because my advice will absolutely save you money. So feel free to give us a call or shoot us an email, and I look forward to being in touch with you. Take care. Bye-bye.